Hey there, it's David Cohen, your local home loan expert. And today I wanted to answer the question, what is an adjustable rate mortgage, also known as an ARM? And whether it's the right product for you or not, to be quite honest. So let's get started with what an adjustable rate mortgage is. Unlike a fixed mortgage, which we're most used to hearing to, for example, a 30-year fixed, where your rate will not change over the life of the loan, that's a fixed mortgage. An adjustable rate mortgage is one in which typically there is an initial fixed period of your interest rate, let's say 5 years, because one of the products might be called a 5-year ARM or a 5-1 ARM, and I can explain what that means. So your rate may be fixed for the first 5 years. After 5 years, your interest rate is subject to change. Now, the terms of your note will describe exactly what financial index your new interest rate's going to be tied to, and what margin on top of that index value is added to determine your interest rate. So for example, let's just say that the financial instrument you're tied to has an index, your ARM is tied to has an index value of 1, and your margin that needs to be added to that index value is 2.25. So by simply adding the two, your new interest rate will be 3.25. Now again, depending on the type of ARM that you have, in most cases, your rate will be subject to an adjustment once per year, every year thereafter. In some cases, this can be risky, of course, because your rate can go up and down, and there are caps in place. In other words, it cannot exceed a certain percentage, and it cannot drop to a certain percentage. And again, these are all spelled out in your note and should be discussed with your mortgage lender up front. But in essence, the adjustable rate mortgage can often provide for lower payments for those first 5 years because they usually have a lower starting rate than a 30-year fixed mortgage, and that's what is often found to be attractive about them. Sometimes people also get into a home and they know firsthand that they're going to have to move in the next 5 to 7 years. Sometimes a 5-year or 7-year ARM is the perfect product for somebody like that because it's going to give them a lower interest rate than the 30-year fixed might. And before it ever adjusts, they're likely going to sell the home. So again, it really depends on your own circumstances. Certainly worth asking about and trying to understand if that would be right for your situation. Of course, if you have any specific questions, don't ever hesitate to reach out. You know how to reach me, and have a great day.